Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today's another AMA episode, that is, Ask Me Anything. I love to answer your questions. If you have a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. Pam in New Orleans asks, Harry Dent recently published a view that says the biggest stock market bubble in history is set to crash. What are your thoughts on what Harry has to say? Well, Pam, this is a great question. Harry Dent is an economist who specializes in using demographics to predict economic behavior. He's also known for having some controversial views. All controversy aside, I agree mostly with Harry Dent's perspective that the market is going to face some significant headwinds. If you think about what drives prices up in the stock market, generally speaking, it's more buyers than sellers. Buyers of stock are people who are in the workforce who put money aside and invest some of those savings in the stock market, the bond market, or in real estate. People who are of retirement age take their life savings out of the stock market and put them into more fixed income securities and use the income to fund their retirement. When you look at the number of people in the workforce compared with the number of people in retirement, we're starting to see an inversion. When the baby boomers were all in the workforce, they were saving for retirement all at the same time and investing in the stock market. With half of the baby boomers now retired and the remainder set to retire over the next decade, that large generation is going to be pulling money out of retirement accounts and out of the stock market for the next 30 years. The generation of people who came behind the baby boomers, the so-called Generation X, is a much smaller population who are still in the workforce. All of the things being equal, we've gone from a period where there were more investors in the stock market to a period now where there's more people withdrawing from the stock market. All of the things being equal, the redemption of funds from the stock market is putting downward pressure on share prices. It's hard to see that right now because we've just gone through a few years of asset price inflation. The valuations we're seeing in the market don't make any sense on a fundamentals basis. So why have prices been going up? Where's all this excess cash coming from that's finding its way into the stock market? The excessive printing of money that has made its way into the financial system and into corporate coffers where banks and financial services companies have used the excess cash to institute aggressive share buyback programs. This has created the illusion of earnings per share growth that's been in fact faster than many companies' underlying earnings growth. Simply reducing the number of shares in circulation, the earnings per share increases. We've also seen insane valuations attached to companies that are losing money. The best examples are rampant from WeWork to Uber, Lyft, Tesla, and Netflix. The valuation multiples being attached to these companies are decidedly in bubble territory. So at some point, when the markets wake up and sanity prevails, we can expect to see a dramatic drop in stock prices. I think we're starting to see the tip of the iceberg with the failed IPO of WeWork. So when is this all going to happen? Well, I'm not sure about the timing. The difficult thing to predict is how much longer governments can inflate the bubble by printing more money. These hits of cash being injected into the economy do have a stimulative effect, but less and less, and they're definitely inflating asset prices. The patient is now resistant to the drug. That's why negative interest rates in Europe for over a decade have done nothing to stimulate the economy there. As an investor, you want to get your money into assets that are an effective hedge, and you want to do it before the precipitous fall in prices. Harry also predicted a precipitous fall in real estate prices. And when he says that, I believe he's talking about residential real estate. There's no question that the demand for the 4- and 5-bedroom houses in the suburbs is falling. Demographics says that demand isn't there at those price points. So we will definitely see homes at the top end of the market fall in price, even as homes at the bottom end of the market increase in price. He also said that cash flow positive real estate is a good hedge, and I agree. He said long bonds are a good hedge, and I'm not sure I agree with that. Paper assets get devalued too much over the long haul. In the case of inflation, savings get wiped out, debts get wiped out, and people on fixed income get wiped out. And bonds are just another form of debt. There's still a ton of cash in the system, and a massive destruction of wealth in the stock market could soak up a lot of the excess cash and make less equity available for investment. On the other hand, a stock market correction could steer more investors over to commercial income-producing real estate as investors search for safer yield. Hard to predict exactly how this is going to net out. Thank you, Pam, for an awesome question. As you think about that, get your money out of the stock market. Have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.